So our first speaker here today to talk about risk management is Jack Hainline. He is a graduate of the University of Illinois. He spent 9 years with Belvedere Trading, both open outcry and algorithms, that monster of algorithms in the way that we're trading today. And now he is a risk management advisor for Advanced Trading. Ladies and gentlemen, please welcome our keynote speaker here from the beginning, Jack Hainline. Jack?
Thank you, Jeff. Thank you, Farm Credit. This is my first time speaking for the Fielding Forward series, so many of you probably don't know who I am, so I thought it'd be kind of beneficial just give a brief background about myself and then have a couple other members of the Advanced Trading team here today as well, and I'll let them introduce themselves as well. So just kind of agenda for today. Like I said, I'll give a brief background about myself, but then I kind of want to go through. It's been a very volatile year in the grain market, so have a little bit of look back where we were at this time last year and what's transpired since we were sitting, maybe possibly in the same room this time last year. Talk a little bit about basis. We're going to auction off a John Deere toy tractor and go through some historical prices, play a little game called Guess That Chart, and then I'll talk a little bit more about what I do on a day-to-day in regards to managing a derivatives portfolio. And at the end, I'll leave it open for questioning. So again, my name's Jack Hainline. I grew up Central Illinois, just outside of Bloomington, where Advance is located at. And as mentioned, grew up in a farming community, went to the University of Illinois, graduated in finance, and took a little bit of a different route than some of my peers. Following graduation, I moved up to Chicago and worked for a company called Belvedere Trading. And so it wasn't necessarily grains trading. We did trade grains, but we also traded a lot of other products. S&P 500 was our main product, but nat gas, oil, gold, silver. So what I was an options market maker. And so anytime someone wants to buy or sell a call or a put option, they have to transact with what's called a market maker. And so a market maker is the person that lays the bid and or the offer. And they're not trying to guess which way the market's going. They're just trying to trade the volatility surface. So it's not speculation. It's basically like a bookie. You're trying to scalp. And so I did that for 9 years. The first 3 years I spent on our algo grains and precious metals desk, so corn, soybeans first, and then moved over to gold and silver for a few years. And then for 5 years, majority of my time I spent trading SPX options in the open outcry pit. That pit, most people think the pits are completely dead. This pit is actually still very much open because it's an options pit. In grains, the futures and options pits are closed, but for SPX, Eurodollars, those pits are still very much open in the options space. And then after that time period, I moved on to become our soft commodities portfolio manager. So a little bit of everything there, algorithmic, open outcry, screen trading, et cetera. After COVID occurred, I have a wife and 2 kids and decided that I didn't really like living in Chicago anymore, and being from Central Illinois, I decided that it was probably a good time for me to make the move, back closer to home. Started at Advance in the spring of 2021, and now in my role, I take my background from using derivatives in a non-speculative way to apply them to a producer's portfolio, so we can use risk management to balance our position both up and down so we can participate on moves higher, and then also assist in storage management decisions, what we're doing with our basis, what we're doing with our cash grain, et cetera. So like I mentioned, I did bring 2 other individuals from Advanced Trading with me today, so I'll open allow them to introduce themselves, but it's Jeff Hainline, he's my father, and then Luke Williams as well. So Jeff.
Hi, nice to be here. I thought I was going to retire about 2 years ago, but COVID hit, and he came back from Chicago. So raise your hand if you had a kid that came back to the farm that you didn't anticipate coming back. So for 40 years, I traded for commercial grain companies, ethanol plants, and crush plants. And so what they're concerned about is transportation differences, where my best market is, the spread relationships between the basis and the Chicago futures market. And so that's what I did for 40 years. And so we talk about how the function of a grain elevator is to make supply equal demand, release the grain when the market needs it. That's the job I had for 40 years, and it was a lot of fun because stuff changes every day. So, like I say, I thought I was going to be retired. I'm a consultant now, so following him around.
My name's Luke Williams. I'm a branch broker just like Jack is, but I'm located just outside of Tuscola, Illinois. I worked for Cardale for 8 years out of school, and then just like Jack was able to come back, grew up on a family farm, wanted to be involved in the farm. And so when we talk about rising inputs and the things that you guys are dealing with on a daily basis, I feel that strongly. So glad to be here.
Appreciate it. So again, just a brief background of what I used to do. So a market maker, like I said, your job is to provide liquidity to the marketplace via bid-ask spread. So on the right side, you can see a picture here. This is just March corn options listed last week. On the left side, you have call options. On the right side, you have put options. They have different prices associated with what's called a strike price, right? So someone's job is to make that market, to say, okay, if I want to buy the March 690 call right now, the bid is 15 5/8 and the offer is 16, right? So if you want to buy that as a producer, right, you got to pay 16 cents. If you want to sell, you got to sell at 15 5/8. That was my job, is to lay that market. If someone bought a call option from me, I wasn't speculating that the market was going down. I would sell the call option, but I would delta hedge it by buying the underlying futures, right? So I was just trading volatility. I wasn't necessarily speculating on the markets, something most people is probably the first time they've heard about what a market maker really does. And there's both electronic, like you're seeing here, algorithmic, and open outcry, like I mentioned. I spent 5 years. This was the pit that I was in. It's still there. It's the SPX options pit. We had a team of about 7 traders on the floor and about 20 upstairs on computers that would all communicate back and forth to each other, trading across different markets, all within the same portfolio, though, trying to accomplish the same goal. So that's open outcry trading. Obviously, used to be a lot more prevalent than it is now, but still exists. So I figured it'd be a good time to kind of look back, think about where we were this time last year. Like I mentioned, it was a very volatile year in the agricultural markets. So, we're sitting here with DEES 23 right around $6, Novi 23 right around 14. Anybody think DEES of 23 is going to be higher than $6 next year, this time, when we come to this, or I guess at December expiration? No hands? Not one person? So everyone thinks DEES of 23 is going to be lower than 6. I mean, because that's all I hear when I turn on the news or listen to a lot of these risk management meetings. But, so let's look back where we were last year, right? So farm credit meeting last year. So this is March 23 soybean charts, right? So we're trading right around 15.20. So this would have been last year at this time, March 2023 soybean futures were trading right around 12.70. Did you come to this meeting last year? What was the message? Wow, 12.70. Pretty good price. Should we be selling some? Would that have been your worst sale of the year? So, we're sitting here this year, just under 14. What is the message you want to hear? Should you be selling some? Maybe. I do not know where the market's going to go. If you expected to come here and tell me, Jack's going to tell us where the market's going to go, I'm sorry to disappoint you, but I have no idea. So my job is to look at what are the odds, right? What are the chances? How can I protect myself? What's the best case of risk management that I can use to do so? So a lot of my background is in probability distribution, using the tools that I have to construct a portfolio to put myself in the best situation that I possibly can. So does anybody know what a straddle is in options world? So straddle, basically what a straddle is the purchase of a put option and a call option at the same strike price, right? So if we're looking at the chart on the right, this is just a DEIS of 2023 corn options, the $6 straddle. So if I went out there and purchased the December of 2023 $6 put, it costs roughly 52 cents. And if I bought the $6 call, it costs, just under 50 cents, so about $1, right? So what does that tell us? That tells us that the person that buys volatility for corn options for DEIS of 2023 has to have the underlying corn future move $1 to break even, $5 or $7, right? Now you're thinking, well, why would anybody ever want to do that? Why don't we just go sell that thing, right? Well, for every buyer, there is a seller. The market's efficient, right? So my old job, a market maker, we're dynamically rebalancing that consistently, right? So a lot of people use options, and the first time that they use an option, they buy it and or sell it and don't look at it until it expires. I would say if you're going to do that, probably shouldn't even use an option at all, right? My job is to dynamically rebalance the portfolio as the market moves up and down, right? And so what we can determine from the straddle price is what is the expected move, right? So that's called standard deviation. So if we have a $1 straddle price, the standard deviation for DEIS 23 corn this year is $1.25, right? So one standard deviation down is 475, one standard deviation up is 725. So 68% of the expected returns this year should fall within those parameters, given what the options market is implying today. So I feel pretty comfortable marketing within that 68%. How do we manage the other 32% that comes from a 2 standard deviation or 3 standard deviation move, right? So if we look at corn, March of 2023, this time last year when we were in this meeting, corn futures are trading right at around 560, Farm Credit Meeting 2022. What happened in February of 2022, right? Russia, Ukraine. War starts. Does anybody still have old crop corn in storage at home? What happened with future spreads? What happened with future spreads last year? Was it a carry or was it an inverted market? Inverted, right? So if we look at May, July future spread, if we have corn in storage on our farm, what happened to the May, July future spread? Can we see pretty easily on this chart where the war started? We go from a 4-cent carry, May, July future spread, this is last year, to over a 40-cent inverse. Right? So if you have, what were all the elevators doing with their bids during this time? They had bids versus, maybe March at the very beginning, but then May. What happened? Did anybody sell grain into Decatur last year? Corn? Did they bid off the May during that time, or did they bid off the July? Why did they roll their bids? Volatility. Jeff, you want to talk about it? Commercial.
Transportation became really short. The whole world for a while thought they were going to have to buy their corn from the United States, and we didn't have enough physical capacity to get it all out. And so the job of the market, when you don't have enough capacity, is run the nearby high enough so that you don't run out. So we were afraid we didn't have enough capacity, and so the May had to go 44 cents over the July to encourage people to wait to buy later. So that's what happens when you get really in a short situation. You'll hear rationing, that's rationing.
And if I'm a elevator and I buy corn from a producer, I'm selling futures, right? Do I want to sell May futures or do I want to sell July? Well, if I sell May futures and I can't get it out because logistics are shot, well, now I'm short May futures that I got to roll forward. So I got to buy May at a 40-cent inverse and sell July. I'm not going to do that, so I'll just go bid off the July, right? So talk a little bit more about basis. I'll come back to futures price. Obviously, there's two components to make up cash price. We try to separate them. They're two different functions, right? Most of the producers I work with have on-farm storage, so my job is to maximize their return to that asset, right? It's not cheap to build storage, so we need to make sure that we're getting a return on it, right? Not a speculative return, but a mathematical return. So what is Decatur basis right now? Anybody sell corn in a Decatur? Is it 20 under? Is it $1 over? Or is it somewhere in the middle? Plus 25, right? Yep. So let's say we've been able to sell plus 30 into Decatur, right? February delivery, right? So pretty decent basis. Anybody remember? I just showed May, July. Where did July SEP? Here, Jeff, I'll put you to work here. First prize I'm going to give away, and probably going to ruin some New Year's resolutions here. But does anybody remember? First hand raised that's within 10 cents gets a prize. Where the July SEP future spread went out on June 30th, 2022 last year, which would have been first notice day. Where did July SEP future spread go out on first notice day last year? Did anybody have corn in storage when July SEP was going bonkers last year? Anybody carry corn last year into the summer? Did it go out at 0, 10 cents, $1, $2? No hands? Nobody wants to take a guess where July SEP went out at? All right, Jeff, I guess you're eating candy. First notice day, June 30th last year. If you had corn in storage, July SEP future spread went out at $1.15 over. $1.15 inverse. July was trading above September futures. So when was basis the highest at Decatur? The posted bid at Decatur, when was it the highest last year? February? No, right? When? April, May. Let's look. Here it is. Blue line is 80 in Decatur, corn, posted basis bid. Right? Where does he get the highest? Right there around July 4th, 5th, 6th, 7th, 8th, right? Plus 120 the SEP. All right, so I'll come back to that here in a second. Remember, let's start in March here. Posted bid at Decatur was roughly 20 over, right? Posted basis 15, 20 over. War starts, right? What'd they do? They rolled their bid to the July. They were at plus 15 the May, but then they rolled their bid to plus 15 the July. Basis looks the same, right? Still plus 15, but May is trading 40 cents higher than July. So what they effectively do? They just dropped their basis by 40 cents. Their effective basis dropped by 40 cents when that happened, all right? So let's say we did nothing and we continue to hold our grain, and then we get to first notice day, end of June. We still have corn in storage. And we say, well, this basis, we're out of corn. This basis has got to improve. Did it improve? Yeah, it improved, but what happened? They bid it off the SEP now, right? And so even though on June 18th, Decatur's paying 65 over July futures, did basis improve from there? Yeah, it improved 55 cents. But guess what happened? Futures dropped $1.15. And I'm not even talking about flat price futures. I'm just talking about the spread. So you gave up, if you stored corn through that inverse, 60 cents in basis. The highest basis you could have sold last year to Decatur was right there in the middle of June. Plus 65 over July was the posted. The effective basis with interest in rolling through the previous carries was roughly 52 over July. So that's a normalized basis. That's how we express what basis looks like, right? So that's a separation of cash down to futures versus basis, which if you have storage assets, you should be looking at. So similar situation right now this year, not as extreme, but what's going on in the corn market right now? Do we have carry or is it a tight market? So this is from last night. March futures trading 671. May 670, July 660. What's everyone talking about right now with their banker? Interest rates, right? So if you've got, Fed funds at 4.3% and your rate is 300 basis points over Fed funds, you're looking at roughly 7.25%. We got 670 futures. We can break that down to 4 cents a month as the cost to own corn, the physical corn, and not have cash that you can invest, right? 4 cents a month. So if I can sell 30 over the March to Decatur right now, what does the equivalent basis have to be? Second prize, Jeff, get your candy ready. What does the equivalent basis have to be in June or what does the basis have to be in June to equal the cost of interest? I can sell 30 over for Feb. There's 4 months. It's 4 cents a month. 46, first candy man right there, right? I have to have 46 over July and June just to overcome the interest. Right? So, what should we be doing with our physical if we can deliver it? That's not an up or down question. That's a interest rate play, right? So I'm breaking out futures and basis right now. So, spend a little time talking about basis. I'll spend, the majority of the rest of the time talking about futures, price risk management. Does anybody have storage at home that they can store their crop on? I would assume in this geography, most people do, right? So, what is the difference between, holding, or does anybody use futures, first off? Why do producers not like using futures? What are the reasons? Margin calls. That's the number one reason that I always hear, margin calls, right? So what is the difference between having long grain, what's the difference between having 100,000 bushels of corn in a bin versus holding long 20 futures in a brokerage account? Basis aside, just the cash side. Margin calls, right? That would be the only difference. But let's say 670 is where corn futures are trading today and they go down to 620. If you have a brokerage account, you see yourself lose $50,000 if you have 100 or 20 futures, right? If you have cash in the bin, you don't see yourself losing 50 grand. Does it have the same effect? Yes, it does, right? So it's just, we treat every bushel the same as a long futures position, whether it be, on the farm or already yet to be sold, right? Or going to be grown in this calendar year, right? We're buying all these inputs right now. We need to be thinking about that as a long futures position. As a farmer, you're kind of always long futures. You're going to continue to grow a crop. So you need to think of yourself as always being long, right? So, Jeff, we're going to switch it up here. We're going to have a little auction, have a John Deere 7R, and we're going to auction this thing off, and we're going to talk about it a little bit and see where this thing goes. So we'll start the bidding. You want to hold it up, Vanna, White, and show it off? John Deere 7R, little model tractor. Anyone have one at home? 330. So we'll start the bidding at $15, and we'll go up in increments of 5. Would anybody pay $15 for this model tractor? $15? Okay, I'll go down to $5. Oh, 15 right here. $15 going once, $15 going twice. Sold $15. This gentleman right over here. Wow, no one has grandkids. I had to hide that in my office for 2 weeks because my son would have taken it out of the box. So, the auction obviously didn't last very long, but during the auction, did anybody think about what I had to pay for that John Deere? What do you guys think that John Deere actually cost? Yeah, who guessed that? Someone's bought one recently. You've got kids or what? $63 for that thing, right? Isn't that nuts? So, my point being though, yeah, good business to be in. My point being, did anybody care what I had to pay for it? No. They don't care, right? So, the tough part is, does the buyer of our product care what it took for us to grow it, right? And the answer is no. So when we think about, what can influence the market in this upcoming year, it's not all these things that the USDA already told us. Those are known, right? It's the unknown, right? So what are some things that can make corn go up $1 this year? Because everyone I talk to says it's going lower. But everything's known currently. So what are some things that we don't know that could happen that can make corn go up $1? Weather, right? Weather would be the main one. What else? Anything else? Another war or extension of what we have going on, right? What are things that can make the market go lower? Weather, right? Anything else? Dollar. Federal dollar, right? Recession, right? You hear about that every time you turn the news on recently. So these are things we don't know that are going to happen, right? And let's say we got the first 3 of them right, but then a recession happens, right? Even though weather's awful and all these other things. We could get 3 of those 4 things right and the market could go the other direction. So for us to sit here and try to predict what the future is going to be is really kind of impossible. It's what I would say is a mindless task, right? So let's have a look back at historical returns. And some of these numbers are kind of interesting to look at. But this is the last 20 years of corn futures, okay? And so I don't know if this thing's got a pointer on it, but in the second column there, Jan 1 price. This is just for that calendar year. So the first one, 2003, on January 1st, December 2023 corn future, or 2003 corn futures were trading $2.42, and on the last trading day of the year, they closed at $2.55, right? So that's what we're looking at. You can see each year, 2012 we started at $5.88 on the first trading day of the year, and we closed on the last trading day at $7.20. Okay, so some pretty volatile numbers there over those last 20 years. So there's 20 observations there. And the average return is 0.88% from the first trading day to the last trading day, looking at December futures, okay? So 20 returns, 9 of those, we had positive years, right? 19.33% in those positive years. 11 of those years were negative, average return in the negative years, down 14%, right? So let's talk about options, everyone's favorite topic, right? So we have a put option, and I'm going to talk in a little bit different terms here, but the reason I'm going to talk in basis points. So anybody have a banker is there a banker in the room? A lender? Farm credit, right? What's a basis point? What is a basis point? Right, so 100 basis points is 1%, right? So if we spent 350 basis points on a down 10% put option, so 3.5%, I'm using basis points because it doesn't make sense to talk about a 20-cent option when corn's trading $6 versus when corn's trading $3, right? So I'm going to stay consistent here. Typically, the down 10% put costs about 350 basis points. So the down 10% put right now in corn is $5.40, right? 60 cents is 10% of $6, right? So 350 basis points is 21 cents. That's just this year's example. If we take that back and look historically, if we bought the down 10% put and spent 350 basis points on it, how many years does that actually make money? 1, 2, 3, 4, 5. 5 years in the last 20, all right? So 25% of the time. Should you expect to make money buying the down 10% put? No, because the market would be inefficient then, right? It would have greater than a 50% chance, right? So Jeff, we'll see if anyone wants some candy this time, but how often, if we buy the 25%, I put delta, that's just your percent chance of something paying out. If we bought the 25% chance put, how often should we expect that thing to expire worthless? 75% of the time, right? So why would we ever buy that thing if we expect it to lose money 75% of the time? compound returns, right? Did anybody have investments in the stock market during COVID, right? What happens, right? If you had a long put option on your 401k, let's say, and the stock market drops, you make money on your put option, but you lose a bunch of money on your stocks that you own. What can you do, though, with that money you make on that put option? You can use it to go reinvest back in the stock market when nobody else can buy because they're already down 20, 30%, and buy at the low, right? So it's reinvesting your earnings, right? The same thing can happen in farming, too. If you are prepared with a balance sheet that when things do not go, your way, you're able to reinvest and pay that higher cash rent, or pick up that piece of land. So in the same way, if we look at a portfolio, if we lose 20%, we have to make 25% just to break even on that thing. So it's compounding your returns over time. So we're going to look at a back test of this. And so using that same chart from before, this blue line here is just looking at if we bought corn futures on January 1st every year and sold them on the last trading day, what would that return look like over the last 20 years, right? And so if we started with $1, we'd have about 80 cents if we implemented that strategy, right? If we just bought corn futures on Jan 1 every year for December expiration and sold them on the last trading day, right? Now, if we take that same strategy and implement that put option that loses money 75% of the time, what does it look like? That's that orange line, right? And it has a higher return overall because we do not suffer the large drawdowns. Then we can actually be a little bit more dynamic, which is what you should be using with your options and rebalancing, saying, if we had a large drawdown the previous year, now I'm not going to spend 350 basis points on a down 10% put, but only 150 basis points on a down 5%, 10% put spread. So I'm not going to outlay as much cash because we just had a huge crash last year. Now look at our returns, right? So we're significantly outperforming, right? So it's just a rebalancing of your portfolio is what we're talking about here. And I'm not just going to talk about the put side because I like trading call options as well, right? You guys have risk that you sell too soon. You have risk that you sell, at this farm credit meeting last year and the market goes straight up, right? So the risk on both sides is there. You need to make hay when the sun shines as well, right? Because we know that, bad years occur as well. So if we look at the vice versa side, if we just bought the up 10% call option, it costs around 425 basis points. So the call option up 10% costs more than the down 10% put option. And I'll tell you why here in a second. But how often has the up 10% call option paid if it costs 425 basis points over the last 20 years? Only 5 times, right? Same percentage, same 25%. All right, so this year it'd be like the D660 call. It costs about 27 cents. That'd be 425 basis points of $6 corn, right? So I just mentioned that the call costs 425 basis points, the put costs 350, but they're the same distance from $6, up 60 versus down 60. Why is that? Why does the call cost more than put, same distance? Does anyone know? It's called skew, right? It's the rate at which we price options on the curve. So typically in commodities, not always, almost always in equities, vice versa, but in commodities, typically the calls equal distance from the at the money will cost more than the put because rallies occur faster than drops, right? Because a drought, right? War, right? We tend to have sharp rallies, slow breaks, right? And so that for that reason, skew is introduced in the options pricing of these particular instruments. In equities, it's vice versa. Puts equal distance from where we're trading cost more than calls because of skew. So if we look at this portfolio return, again, same blue line as previously. If we just held long, we'd have 82 cents on our dollar. But if instead we sold, and I know no one's going to do this, but it's just for, example, if we sold our APH and just bought the up 10% call on Jan 1 every year, what would our returns look like, right? And it's that orange line. What if we just rebalance that, and instead of just buying the up 10% call, if the market rallies 20% one year, and instead of buying the up 10% call again the next year, what if we were more conservative in our approach and just bought the up 5%, 10% call spread and only spent 150? Then we have the grain line as portrayed, so even a better portfolio return. So, kind of to bring it full circle here, if we're not using options, we're doing some sort of incremental or scaled selling, right? And there's really kind of two types. One being time-based. That's where we, market based off time of the year, sell 20% in spring, another 30% in summer, sell the rest sometime after harvest. Or price-based. Every 10% crop rallies, I'm going to sell a certain amount percentage. What happens, though, when you get a large bull market is you make a lot of early sales, and then, you just deviate from strategy, right? Because the market's just rallied $1.50, and I can't keep selling at this pace because I'm going to run out, right? So, Mike, we'll play a little game here to bring this home, but Jeff, I need you to be Vanna again. We're going to guess that chart game, okay? And so we're going to try to guess what this is prior to me showing the full thing, and I'll bring it full circle here too. But this is a commodity. It historically, before 2000, typically traded around $30. And just first one to shout it out. Reached a high back in 2009, and this hasn't been updated recently. They got up to $1 or $145. The crude oil, who said it? Right there in front. Yep. Crude oil. Remember in April of 2020, it went negative $37 crude. Anybody think, wow, I need to drive down to Oklahoma and load up my truck? Negative $37 for crude. So that's a breakdown in the futures contract in the supply chain, right? So this one is a stock, okay? In August, November 2020 timeframe is trading 70 cents. Then in the January, February, March timeframe of 2021, it went up to $81. From 70 cents to $81. No. I heard it over here. GameStop back there, yep. Do you guys remember this thing? So everyone's like, wow, I wish I would have owned GameStop. If you owned GameStop at 70 cents, where would you have sold it? Right? I mean, so, and some people are like, oh, I would have never sold it. Well, yeah, you also would have rode it all the way back down too, right? So, and you could say the same thing about Bitcoin or whatever, right? So it's just, you don't know where these things are going to end. And so it's the same thing in marketing our grain, right? Well, $6 corn's great. Or the guy that says, well, it's going to 7. Well, if you sell it, are you going to sell it all at 7? Well, no, because it might go to 10. Well, are you going to sell it all at 10? Well, no, it might go to 15. Right? So it's just how can we use risk management to participate if that were to happen? Because I'll tell you, most people will sell before it gets there, right? Because they're scared it's going to go back down. And if they don't sell, then they will usually watch it go back down. Last one, or second to last one. This is got a low of $1.54 back in February 2020 during COVID. A lot of these charts have lows during COVID, right? Got up to $9 here in the past year. It's a commodity. Natural gas right here in front, right? Right here in front. So this is used in the production of a lot of our inputs, right? So these prices have been coming down. Here's the last one. It's an older chart. 2013, what is it? What is it? Nope. 2013 is the calendar year. Corn. Jan 1 to the end of the year, started at 593. Where we are right now, finished at 412, right? So I don't know what the future holds, but what's our plan if that happens, right? So in regards to, what I'm talking about is incrementally selling. If you own GameStop at 70 cents and it goes to $81, are you going to sell it all in one chunk? Are you going to sell percentages everywhere it goes, right? So if we're incrementally selling, all we're doing is we're changing our slope or our trajectory. It's a linear path, right? We have no convexity within it, meaning my slope stays the same. If I'm 25% sold, I'm 25% sold corn if it goes to $7, if it goes to $8, if it goes to $5, right? I want to be more sold when it goes down and less sold when it goes up. How can I do that, right? And that's by implementing options, long volatility into our portfolio and dynamically rebalancing it so that, this black line is the strategy. It's got a floor in place, right? I'll talk about a little bit how we can implement this with crop insurance. Black line's just 25% sold strategy, long a D7 call for 20 cents. And this is a very vanilla, just for purpose of example. 75% of the portfolio is not sold, long D's 550 puts, right? We got a floor of 39 cents if we have a break even of $5. So these are kind of them just smashed together. On the left is if we walked in here today, we have a break even of $5 and we haven't sold anything. That's just our rate of participation. On the right is what a put option payoff diagram looks like, right? If we spend 25 cents on the D's 550 put, most we can lose is 25 cents. If we go down, right, we're going to make money on the put option. If I put those together, long no D's put, don't sell my grain, it looks like that, right? I got a floor in place. I have unlimited upside at a participation of 100%, right? So if GameStop happens and corn goes to $9, right, I've got that put option and I didn't have to worry about selling too soon, right? So it is this simple. On sold production, you have a risk. It's that you sell too soon. You sell D's 23 corn at $6 and it goes to 8 because of all these things we don't know, right? Everyone says it's going to 5, right? But if they knew that, then they would be trading on a beach in Florida. So on unsold production, we have a risk too, that it goes lower, right? And so how do we establish that floor? We buy a put option, and our upside is we haven't sold the bushel. So like I said at the beginning, if you just go out there and buy an option and never move it, I would say don't ever use options, right? The benefit is by being able to rebalance them, right? Meaning if the market moves, you should change your marketing plan. So really, after you trade an option, there's 3 things. Gamma scalping, I'll just briefly say what it is. It's the ability to rebalance your portfolio as the market moves. Gamma is just a Greek term that is the second derivative of price, is what it is. But there's really 3 things the market can do, right? And it can go up, down, or stay the flat, right? And so if we buy options and the market stays flat, there's really nothing we can rebalance, right? The market's not moving, right? And you're going to lose your time decay, right? But how do you pay for time decay? You can rebalance your portfolio during the time that you own the option, right? So how do you do that? If we went out there and let's say today, we're not comfortable selling 90% of our corn, which I would say was, typical. People this time of year, I would say 10% is the comfortability of level they want marketed. On the other 90%, we're not comfortable selling today. So what can we do? Well, if we went out there and bought a D's 550 put, and it costs us 25 cents, futures are trading $6, what's our floor? It's $5.25, right? Strike price minus cost. So market can do 3 things after I buy that put option. Up, down, stay flat, right? If the market were to go up after I buy it, does anybody have a quarter with them? There's a planted one right there, isn't there? You have a quarter? Would you give me that quarter if I gave you this $1 back right away? You would, right? Right. So what I'm saying is I have a 550 put. The market is going higher, right? Is that a good thing? Yeah, I own these put options because I haven't sold my grain, right? If the market goes up and I can sell that 550 put I own and buy the 560 put and spend 2.5 cents to move that put option up during the middle of the growing season, Should we do that? The market is going up. I haven't sold my bushels. I own a put option. Let's say the market goes up a dime, right? And I have 100,000 bushels I haven't sold. Theoretically, I've made 10 grand. Should I take some of that risk off the table and put it back in my pocket? Because I can guarantee myself a 10-cent higher floor for 2.5 cents, right? So every time the market goes up, and I don't care how high the market goes, I'm going to try to move that put option up because it's going to prevent me from selling too soon, right? It's like if you're climbing up a mountain and you have a net underneath of you, right? You feel pretty good to keep climbing up that mountain, right? But if you let that net drop and it's 40 feet below you, now I don't feel so good, right? I don't want to keep climbing that mountain. So I'm going to keep that net right underneath me as long as I climb up that mountain. And I don't care how much I lose in these put options because I know that I'm going to sell grain higher than where I started at, right? Now, let's talk about the other way, right? We talked about up, let's talk about down. If the market starts to go lower, what are we going to do? Well, if I own a 580 put option, I spent 25 cents initially, I put another 7.5 cents into it, so I'm in for 32.5, right? Market's going lower. I got a 580 put, right? Let's say market gets up to 6, now it goes boom, 550. Report comes out. I got a 580 put. Do I feel good I have that 580 put? Yeah, because I got 30 cents of equity in it, right? 580 put, market's trading 550. What am I going to do? Well, I got this money that's sitting there, and I want to make sure I hold on to it, right? So if I can take that 580 put that I own and roll it down by selling the 580 put and buying the 570 put and collecting 7.5 of that potential 10 cents right now today in the middle of the summer and put it in my pocket, I'm going to do that, right? Because what if the market goes back up? What I don't want to have happen is the market go down, I own a put, and it looks real good, and the market goes right back up. And I was like, well, shoot, that put didn't do me any good, right? I want to take that money and put it back in my pocket, right? So every time that I can move that put down and monetize it, I'm going to do so. Because what do I want to happen? I want the market to go back up because I have bushels I haven't sold that I own this put option versus, right? So every time I can do that, I'm going to try. So that was on the 90%, let's say, that we haven't sold. On the 10%, that we're comfortable selling, let's say we sell futures or HTA or cash sale at $6, right? And we go out there and we buy the December $7 call option. It costs us 20 cents, right? So the call options give us participation on the upside. How do I monetize that? How do I rebalance my portfolio? So if I go out there and I buy a D7 call for 20 cents and the market goes up, that's good because I got 90% of my bushels I haven't sold, right? On those 10%, I'm like, oh, shoot, market went up. Shouldn't have sold those, right? Good thing I got this call. Market starts going higher. Let's say I own a $7 call. Market goes up to $7.50. What do most people do? They watch the market go higher, and they'll say, yeah, this call's making money. And then the market will go lower, and they say, well, shoot, those calls didn't do me any good. Or they'll sell the call because they finally made money on one of these things, and then the market goes another $1 higher, right? And they're like, oh, geez, why did I get rid of these calls? So what I want to do is I want to rebalance so I'm still in the game if it goes higher, but if it falls out of bed, at least I knew I took something off the table, right? So I own a $7 call, market goes up. Can I take that $7 call I own and sell it and buy the 7.10 call and collect 7.5 of that possible 10 cents and put it in my pocket today, right? And so every time that the market goes up, I'm trying to roll that call option higher. So I'm rebalancing my portfolio. It doesn't matter if, Russia bombs Ukraine in the middle of the night, this is happening, right? Automatically, right? So it's not Jack thinks the market's going up. It says math says that I can move my call option higher, collect 7.5 of my 10 cents right now. I'm going to do that, right? So that's how we rebalance the portfolio dynamically when the market moves, right? And puts ourselves in a better position. Eventually, you're going to have to sell those bushels, right? And so when you sell the bushels, you should sell your put option. You don't need it anymore, right? Put option protects you from lower prices. When you sell the bushels, you sell the put. You can use the sale of the put option. These put options retain value until they expire to purchase the call, and now you still have that same portfolio. You sold the bushel, you own the call, you still have upside, your downside is defined, right? And so I talked about rolling the put options down. At some point, you're going to get down to your crop insurance level, right? You should have crop insurance. You do not need the put option anymore. You can either sell it out or you can monetize your crop insurance during the middle of the growing year because you don't know what harvest price is going to be until October, right? So, 85% of, what is it? 85% of $6, right around 5, right? So if we get down to $5 and it's June, you're going to be hitting close to crop insurance level. If we go down to $4.50, you would have a theoretical indemnity, but only if we finish there, right? So can I monetize crop insurance by rolling that put option down June, July, August? Because if we go back up, now I don't have an indemnity anymore. So you can use your options with your crop insurance in that way. I'm not going to own a put option if we get down to crop insurance because I don't need to be double insured, right? So they work together. And so what I'm really talking about is just rebalancing our portfolio in a delta-based manner, meaning if I own 20 put options, let's say I'm going to grow 100,000 bushels of corn in 2023, and I go out there and I buy 20 put options. There's 5,000 bushels per put option per contract, so I'm fully covered, right? That put option's got a 25% chance of finishing worth something, right? So it participates at a negative 25% relative to corn futures. So my slope, right, my rate of participation at the time that I execute that is 75% or $75,000, right? Now that's static, right? So if I go out there, let's say, and I sell 20,000 bushels, what am I going to do? I'm going to sell the 4 of those 20 put options that I own. Now I only own 16 put options. I can use the value of those 4 put options to go out there and buy 4 calls. Now I have the same portfolio. The 20,000 bushels I sold are protected with 4 long calls. The other 80,000 I have not sold are protected with 16 long put options, right? And so you can see I've changed my slope again, but all of my bushels are still protected to the downside, and all my bushels still have upside participation. So my job and what I do with the producers that I work with is talk about what our rate of participation is as corn futures move up and down. We do not spend a whole lot of time talking about where we think futures are going to go because we don't know where futures are going to go, right? So what is my rate of participation? What rate do I want to be participating at? How much upside convexity do I want to have in my portfolio? So, kind of in theory, in summary, if you dynamically, implement an options portfolio and manage it mathematically, you're going to manage to those extremes. So you can think about yourself when the end of February last year happens and Russia-Ukraine's going on and the world's on fire, right? You're going to be the person that's saying, this is fine. I'm ready to take advantage of whatever the world gives me. And in both scenarios, you're going to embrace volatility and cheer for higher prices. So with that, I'd like to open it up to any questions.
As the market's going up on your bottom one, what are you doing with your put options? And isn't there a cost to execute each one of those?
Sure. So you're saying, so on 90% of, let's say we're going to produce 100,000 bushels. On 90,000 of those bushels, or 18, we're going to own 18 put options, let's say. On 10,000 that we sold, we're going to own 2 call options. So I'm rolling the call options up at the same time I'm rolling put options up. So if you think about a portfolio, your call options rolling up will fund your put option rolls up, right? So if you're collecting 7.5 cents every time you roll a call up, and you're having to pay 2.5 cents every time you roll a put up, you only need 1/3 the amount of calls that you do puts for the portfolio to fund itself. Does that make sense? Okay. Any other questions? Thank you.
Jack, hang on. They've got the mic out there. I'm going to bring this. Let's do this together. How many of you feel like for 2023 there is more upside in soybeans than downside? More upside than downside. How many of you think there's more downside in soybeans for the year ahead? Okay, at this stage of the ledger, how many of you feel like there's more upside in corn? We got a bull over here, I love it. What about downside, more downside in corn? That's interesting. From the news aspect, you got to listen to Brazil, you got to pay attention to those kind of things and say, yeah, if they turned out another billion bushels and if China has COVID effects and they don't increase as much, there's a good chance that things slide. But on the corn side of the equation, what the global numbers tell us? Not really a burdensome supply. if this weather turns out of Brazil and that safrina crop doesn't do as well, Ukraine's off the table from what they used to be in terms of selling into the global market. If Brazil has any problem with all of safrina and Ukraine can't produce, the U.S. has an opportunity. So all the more reason to look at this, protect myself on the soy if you think there's more down than up, and for corn, maybe some opportunity there based on some other factors, and especially on both of those if you look at how renewable fuel demand's coming along. So options are a beast, and the one thing that I saw is you're not selling the golden goose with golden eggs. Once you buy one of these things, you can't just put it in your pocket and say it's there forever. You still have to manage it, don't you?
Yeah, yep.
All right.